If you don't already know, SCHD is one of the most popular dividend ETFs on the market when it comes to its dividends and dividend growth. With a dividend yield of around 4%, a consistent dividend growth track record with 13 years of consecutive dividend growth, and solid performance with 10-year annual returns of over 11%. It's no wonder why so many people like and invest in SCHD. And while it can be a great pick for a dividend investor, it's not 100% perfect. And in this video, we're going to get into the 5 ETFs that I think could beat SCHD in the next few years while still paying you some dividend income. So let's get to it. The first ETF on the list is DIVB, the iShares Core Dividend ETF. DIVB tracks the Morningstar US Dividend and Buyback Index, so it holds US stocks that have a history of dividend payments and/or share buybacks. A stock buyback is when a company repurchases its own stock, reducing the total number of shares available on the open market. And this can benefit the investors because their shares will appreciate in value. DIVB currently holds around 413 stocks, with its top holdings in big names like Cisco Systems, IBM, JP Morgan Chase, Accenture, and Exxon. When it comes to sectors, DIVB is exposed to technology and financials, which make up the majority here. Then there's healthcare, industrials, and a few others. For the dividends, DIVB has a dividend yield of 2.8%, which is dividends are paid out quarterly. It also has a 5-year annual dividend growth rate of 15%, and you can see over the years this dividend has grown quite a bit, especially in more recent years, with its fund construction logic having changed at the end of December 2022. Jumping into the performance for DIVB, it had annual returns of 12% since its inception almost 8 years ago and around 18% in the last 5 years. Definitely some nice results there. And for the cost, this fund has a low expense ratio of 0.05%, so you'd be paying $5 for every $10,000 invested. This is a good fund to own for investors with a longer investment horizon who are looking for a fund that offers both capital appreciation and dividend growth. If we compare the last 5 years of DIVB to SCHD, you can see there's quite a difference in growth there. This can be attributed to DIVB's pretty large chunk of exposure to the technology sector, which improves its long-term growth potential. This is also one downside of DIVB, the higher risk drawdown. And while its yield may not be as high as SCHD, I think it's fair to say while the strategies of these two funds are different, for growth and a return standpoint, I can see DIVB continuing to outperform SCHD in the future. This next fund is FDVV, the Fidelity High Dividend ETF. FDVV seeks to track the performance of the Fidelity High Dividend Index, which invests in large and mid-cap dividend-paying companies that are expected to continue to pay and grow their dividends. FDVV contains a total of around 120 stocks, with its top holdings in companies like Apple, Microsoft, Nvidia, JP Morgan Chase, and Visa. While the top sectors that it's exposed to include technology, financials, consumer staples, and real estate. Moving over to the dividends, FDVV has a dividend yield of 3.2%, which is dividends are paid quarterly. FDVV has had a 5-year compounded annual dividend growth rate of nearly 4.5%. And if you look at the dividend growth it's had over the years, while it has improved, it's not the best here, which is likely due to its exposure to tech holdings. FDVV has shown solid performance when it comes to returns, with annualized returns of a little over 12% since its inception in 2016, about 9 years ago, and over 20% in the past 5 years, which is really great. Getting into the fees for FDVV, it comes with an expense ratio of 0.16%, costing you $16 for every $10,000 invested. FDVV proves that it can be a solid dividend ETF to capitalize on future market growth, especially if it's driven by the tech sector. This is something that SCHD lacks in comparison with its more limited possible growth potential. Now, this of course can be a source of weakness for FDVV if growth slows down a bit, as well as the fact that this makes it more vulnerable to market downturns. But overall, this is a strong fund that gives you a nice dividend yield, good returns, and the opportunity for possible outsized growth. This third fund is DGRW, the Wisdom Tree U.S. Quality Dividend Growth Fund. This fund invests in U.S. large-cap companies that pay dividends and have growth-oriented characteristics. DGRW's approach selects dividend-paying large-cap stocks with solid projected earnings, high return on equity, and return on assets, making for a well-rounded large-cap portfolio. This fund holds around 303 stocks, with its top holdings in familiar names like Microsoft, Exxon, Apple, Procter & Gamble, and Home Depot. When it comes to its sector exposure, DGRW's top sectors are in technology, consumer staples, and industrials. For dividends, DGRW has a dividend yield of 1.6%, which is on the lower end compared to some of the others on this list, and it also pays the dividend quarterly. DGRW has a 5-year compounded dividend growth rate of around 3.7%, which is not the best, but if we take a look over the past 10 years of dividend growth, we can see that it's been relatively strong, with it slowing down in more recent years. The performance for DGRW has definitely been good, with 5-year annual returns of around 17% and 10-year annual returns of a little over 12%. Hard to complain at these results. For the fees of this fund, DGRW has an expense ratio of 0.28%, meaning you'd pay $28 for every $10,000 invested, marking this as easily one of the highest here. In comparison to SCHD, right off the bat, DGRW definitely falls short in the dividend yield while also costing you more in fees. One of the biggest differences here is going to be the opportunity for more capital appreciation. For example, you can see here the performance over the last 5 years between the two, as well as the gap in the last 3 years in returns is quite large. DGRW is also pretty diversified in the amount of holdings it has and its sector exposure, although tech does add to its risk, which it does have the upper hand with tech exposure compared to SCHD as far as returns go. But another nice thing to note is that its exposure to other sectors like consumer staples, healthcare, and industrials could help in cases where tech is taking a big hit. The fourth ETF on the list is DGRW, which is the iShares Core Dividend Growth ETF. DGRW tracks the Morningstar US Dividend Growth Index, which is made up of stocks that have a history of consistently growing their dividends every single year across a wide variety of industries. Currently, DGRW holds 417 stocks, with its top holdings in JP Chase, Exxon, Microsoft, Johnson & Johnson, and a few others. When it comes to the sectors, DGRW has exposure primarily in financials, technology, healthcare, and consumer staples. DGRW has had a pretty decent dividend yield of 2.3%, which is paid out quarterly, and it has a 5-year annual dividend growth rate of 7.6%, and to top it off, it's had 10 years of consecutive dividend growth, so it's not slacking here. There has been some great consistency in dividend growth. DGRW has also had some solid performance, with annual returns of over 16% in the past 5 years, while over the past 10 years, returns of around 11.5%. Getting to the fees, this fund has an expense ratio of 0.08%, so you'd be paying $8 a year for every $10,000 invested. DGRW can be a good pick for those who are looking for a solid, diversified dividend ETF with consistent and strong dividend growth. And it gives you exposure to a nice mix of both value and growth stocks, which you won't find in a more value-focused fund like SCHD. If we take a look at the past 3 years, you can see the gap in performance between these two quite a bit. And even when stretching out to a 10-year span, DGRW has led the way in returns, which I expect for the foreseeable future. This next fund is VIG, the Vanguard Dividend Appreciation ETF. VIG tracks the performance of the S&P US Dividend Growers Index, and this index concentrates on US stocks with a strong track record of consistently increasing their dividends every year, and it's mostly made up of large cap companies. This ETF currently holds around 338 stocks, with its top holdings in Apple, Microsoft, Broadcom, JP Chase, and Eli Lilly. And the sectors that make up a majority of this fund, you have technology, financials, and healthcare, which is just about 50% alone, and exposure is due to tech and financials. The dividend yield for VIG is about 1.8%, so it's on the lower end here, with its dividends being paid out quarterly. But VIG has had some great dividend growth with a 5-year compounded annual growth rate of about 11% and 11 consecutive years of dividend growth, so double digits for both of these. And this is good news because while VIG's dividend yield isn't anything amazing, it's nice to know that its growth over time has been consistently strong. VIG has also had some good returns, with annualized returns of around 15% in the last 5 years and a little over 11% in the past 10 years. Moving to the cost, this fund has an expense ratio of 0.05%, so you'd be paying just $5 a year on $10,000 invested. VIG offers a nice package of dividend growth along with the potential of capital appreciation. And while its dividend growth is not as strong as SCHD, its returns do outpace it. For example, in the last 3 years, it's performed better than SCHD, and zooming in into the past year with the recent uncertainty and declines in the market, it manages to still hold well over SCHD. I think for someone with a longer investing time horizon that wants dividend benefits with capital appreciation potential and something that's a little more tech leaning, then VIG has the edge here. While SCHD is a great dividend ETF, it does have its weaknesses, just like any other fund would, including the ones on this list. This doesn't mean that you should steer away from SCHD, as I believe it's still one of the top dividend ETFs to this day, and I think it can complement well with many different ETFs, including the ones mentioned on this list. And ultimately, whether or not a specific ETF will be worth it for you or not will heavily depend on your investing strategy and goals. Now, if you want to see some options on some great monthly dividend ETFs, then take a look at this video here. Or if you want to know the best ETFs to combine with SCHD, be sure to check out this video here. And if you made it this far, I really appreciate you for watching. Keep investing, and I'll be seeing you on the next one.